Hey everyone, happy Valentine's Day. I made this all by myself, but hey, it's the best I could do. But I want to wish all of you a happy Valentine's Day. As those of you who read my Substack know, this is something that I say that in the end, the only thing, that's there in the end is love. So, all right. With that, today I'm going to do something different. I'm going to do a bit of a series of updates. I've gotten questions on staking because of something that the SEC did with a crypto exchange called Kraken. Today we had inflation numbers released, and I believe that it's setting up for something that I believe is really good for us, and I just want to lay that out for you. But before I do any of that, I want to go through a disclaimer, which is that anything that you see on this channel or hear on this channel, not investment advice. Second, past performance does not guarantee future performance. Capital loss, in other words, losing money, is something that is possible with any trade, speculation, or investment. All right. Quick plug for my company, atgdigital.media. That's the website. That's where paid subscriptions would start at $9.99. You can also check out my Substack, paulmampilli.substack.com. Yeah, I did misspell my name just for a second. Happens. All right. Let's go first to then the crypto update. So many of you wrote me and said, hey, Paul, it seems like the SEC is looking to wipe out staking in the United States. They took this action with this exchange called Kraken. And essentially, people want to know what is going to be like the effect on staking, particularly for Coinbase, because this is the primary place where most people who are really invested in crypto, this is where they've got their crypto. Now, from doing research on what the SEC did with Kraken, what Kraken was doing, various analysis, my actual opinion is that nothing's really going to change for folks like Coinbase, or if you have your money, you're an advanced crypto investor and you've got your money in projects like Lido or Rocket Pool or those things, nothing's going to change. It does seem like the SEC was really taking issue with Kraken in particular, which is that Kraken was not just providing staking returns like Coinbase. So, for example, if you're a Coinbase, you hold your crypto at Coinbase, you can stake your Ethereum, for example, and they will give you or pay you something like 3 to 4% a year in Ethereum back. And for those of you who don't know what staking is, essentially like leaving your money at the bank and getting interest, except you get it back in crypto. So Kraken was doing something a little bit more enhanced, if you will. They were taking people's money and then they were actually promising them 15 to 20%, right? You're not getting 15 or 20% by staking your Ethereum at Coinbase. So clearly Kraken was doing something different. And it looks like what they were doing is sort of taking assets into some kind of pool, using the sort of like crypto world, crypto economy, crypto markets to generate some extra return. And as we now know from FTX, Celsius, Voyager, and all the others, well, nothing's ever, you don't ever get something for nothing. So if Coinbase is paying you between 3 and 4% for Ethereum staking, and Kraken can promise you whatever, something that is much higher. I mean, I know for some crypto staking, they were offering returns as 15 to 20%. There's got to be some reason for that. And that's additional risk. And it does look like this is the part of what Kraken was doing that got the attention of the SEC. They have cracked down on it, if you will. It's going away. In my opinion, my judgment, based on everything that I read, nothing's going to change for US residents that are using services, staking services like Coinbase or projects like the ones I've mentioned before, because essentially what they're doing is sort of flowing out your cryptocurrency to the underlying protocol or project or token and sort of flowing back the staking returns back to you. That seems, from my judgment, from my reading, to still be something that is going to continue and be okay in the United States. Now, that's not a guarantee, I'm sure that if the SEC is going to stop staking across the board, then Coinbase will send a notification and say they're going to unstake you and give you back your returns. But still, I did notice that in my reading that even Kraken, because of the Ethereum is staked by contract, that's going to stay staked until that is actually released at the crypto and token and project level. So bottom line, I don't think a whole lot is going to change if you are staked in to various cryptocurrencies at services like Coinbase and other places. Certainly, I plan to leave my Ethereum at Coinbase stake as it has been for a long time. So that is the update on crypto staking as it relates to what the SEC has recently done with Kraken and that exchange. Bottom line, I don't expect a lot to change, which is that regular staking without some enhanced element to it is going to continue. That is what I believe. All right. Now, updates on macro. So this morning we had inflation numbers released. And while, the CNBCs of the world will say that, it came in above what expectations were, my takeaway is that inflation is no longer accelerating. In other words, when you look forward, you can actually begin to see it actually decelerating. In other words, where you can start to look forward and see like, yeah, price is actually setting up to go down. And the way you can do that is looking at input costs or the components that make up inflation. For example, transportation. Well, go look up, the cost of trucking, of goods and shipments. It's completely crashed. Energy inputs like natural gas, which is a huge input for the industrial economy, it's gone from what, 10 to something like $3, also crashed. So many agricultural commodities, soybeans, corn, etc., wheat, they've all gone down by 30, 40, 50%. Those are all input costs for, everyone that uses it to make products and services. Housing supplies, lumber in particular. The cost of lumber has just completely and utterly crashed. So when you look at all of this, and there's obviously so many more, this is just an example, what it points to is that, you look out 3 and 6 months, all these input costs are going to get embedded, into the prices for things in the second half of this year. And that points to decelerating inflation, disinflation, and in some cases, probably deflation. But we'll not get into all that. When I look at what is going on, in my opinion, long-term inflation is headed back to 2% or less. The or less part is really driven by, what we invest in, innovation. And I'm not going to get into that into this update. I talk about innovation all the time. So that, this is something, innovation only happens when you can essentially do it on some level cheaper. But as a start, we're headed back to 2%, in my opinion. One difference that's going to be between the period in 2020 and 2021, when interest rates were very, very, very low, like corporate bonds, they could sell bonds for like under 1%, like 0.5%. Well, that's not coming back. And the reason for that is that wasn't driven necessarily by deflation or inflation numbers. It's really driven by the fact that the Fed was buying bonds at a crazy level and artificially manipulating those interest rates lower. So interest rates are going to come back. They'll come down a little bit, but they're not going back to where they were in 2020 or 2021. But bottom line is that we are going back to low inflation, low growth as a primary long-term trend, which is what we were experiencing sort of like pre-COVID. I think 2018, 2019, that was the scenario. So low inflation, low growth is very positive for stocks that have growth. It also supports continued sort of money flow into crypto. Many crypto projects, represent digital economies, digital businesses that have very high rates of growth, which in a low growth environment is something that, is highly desirable. Who is this bad for? Well, it's bad for companies with very high levels of debt and that need inflation to show growth. Many of these consumer companies have really benefited from inflation by being able to lift prices because the price of those inputs, as they went up, they could justify price increases. You can't do that anymore. So it's bad for them. And those folks also happen to be the folks with the greatest amount of debt. So not good news for them. Bottom line, things on a macro level are essentially going to go back to where they were pre-COVID, low inflation, low growth. And in that environment, growth assets, I'm talking about growth stocks, ROGI investments, opportunity growth and innovation investments, outperform because growth is scarce. And because of that, it is valuable. And because of that, it is in demand. So I am very bullish, very optimistic, very positive on this Valentine's Day in 2023 because things are effectively going back to where they were sort of pre-COVID, at least on a macro level. But underneath all the changes that have unfolded, just think about it, work from home being such a big thing. Like it's estimated that as much as 30 to 40% of people now work from home. So that's a very, very large change. Think about how many people have left large cities and to move to states in the South. Well, that's a permanent change. All those things actually benefit our investments. So I am very BOP on what I believe is going to unfold in the second half of 2023 and beyond, because all of these things are incredibly positive, phenomenally positive for our investments, our growth stocks, and our crypto. So if you like analysis like this, please check out atgdigital.media, check out my Substack. And if none of that sounds good, well, then give us a thumbs up, subscribe to the channel. Come back next week. This is Paul saying